day. My name is Cal Everett. I'm the CEO of Liberty Gold Corp. Sitting next to me is John Gilligan, our COO and president of the company. And Liberty Gold is focused on arlin-style sedimentary hosted oxide gold systems in the Great Basin area of the United States. Our major project is called Black Pine in southern Idaho, and then we have another gold deposit called Goldstrike in southwest Utah. And we're advancing these projects through to a production scenario. In sequence, we're looking at, I would say, Black Pine first and then Goldstrike second.
Good, Cal, good to see you again. So you're back in London. And John, welcome back.
Thank you.
This is the three amigos back together. Right, we're here in Toronto, PDAC, pretty darn busy over there. What's the mood when it comes to gold companies?
Are you talking about this conference or the conference we were at before that at BMO?
Oh, you're kidding. Yeah, you forgot you've got a big long road show. Well, tell me both.
Yeah, well, BMO I thought was fascinating in the fact that it seemed to be three commodities there was interest in if you're into metal space. Yeah. And that would have been uranium, gold, and copper. Okay. It was finite in that way. I didn't find that much interest in just pure base metals without a precious metal association of some sort. Here it's more, you get down into the more greenfields type companies and you see the standard geologists and prospectors with their maps and booths and things like that. Yeah. It's kind of quaint to go from there to come over here and see the different.
Yeah, it's interesting. I took a run around the shop floor yesterday, so a lot of service companies as well, so selling their wares. But okay, let's stick with gold because that's what you do, that's what you're going to do. It's been a tough few years. We talked about it last time out. Is there any sort of light at the end of the tunnel? You know, is this this gold price of plus 2,000 doing anything for anyone?
Well, it's putting a base to the gold market, I would say. The gold market has it because I've been doing this for about 40 years. The gold market tends to step up and then fall back a bit. But you just want the progressive steps to be slightly higher than the last step back. And that's what we're doing right now. So you could go up to 2150 or something like that for the price of gold, but if it fell back to 2075 to 2100, that's a step up, and that's what you need to base a market. And that brings in more confidence into the market. It does not necessarily guarantee that the capital's there for the early stage companies. For a company like Liberty Gold, our benefit is we can manage our own clock. And by that, it means we have a time that we want to do this, deliver that, and the next thing, and you time it all out. And once you meet those deliverables, you're going to meet your development timeline, and John can speak to that as well. And so as long as you understand that you've got a clock, and you know when you're expecting to go through the NEPA process and get your permit for construction at Black Pine, you just keep ticking those boxes. And if you stumble, you're setting yourself back in time, and that's the most important part.
Right, okay, and I agree with that. There's a few things, a few conversations we've had since we hooked up in London, which is, it's quite clear that CEOs are getting braver about saying there's a new cost environment, things are more expensive, there's a new reality out there. And margins, as long as gold keeps doing its thing, will still be there for us. So don't worry about that. So the high cost environment is one thing. I'm talking about specifically, John, you might have a view about this. ASIC used to, let's aim for 1,000. CEOs are saying, well, actually, the new reality is probably like 1,250, 1,300. I mean, on average, right?
Might even be higher than that. Actually.
Might even be higher than that. I think some of the Yukon guys would definitely say that. And get used to a new set of numbers. But what your job is to do is make sure that those margins remain robust. And you're going to need a lot of help from gold this year to do that. So, gold. What's going to stop it from moving forward? Because the normal rules don't seem to have applied recently.
Well, I've been trying to research it. I can't find enough information on the new Shanghai Physical Gold and Silver Exchange and try to get some sort of numbers of what they're buying, right? So you've got to get that figured out. You've got to figure out interest rates environment. You have to look at inflation. You can see inflation slowly trending lower, and then you've got to look at the US dollar and whether it's showing any signs of weakness whatsoever. And all of those 3 or 4 items ultimately has some sort of effect as a group on the price of the metal. It's as simple as that. And all of a sudden, if they raise rates in the United States, the metal's going to drop, right? And so we've gone through that rising rate scenario for quite a period of time, and now it's time to flatten them out and at least give the market an indication as to where you're going to go on rates. And there's a pending Powell discussion coming, I think it might even be this week, that's going to see where he's going to go with rates. And I think he's just going to hold them steady and not give up any indications that rates are going to drop.
Okay.
Right?
That's the backdrop. Control your timing. You're in control. Markets slowly feeling their way to hopefully some sort of change. And I guess what I'm interested in is companies like yourselves, mind builders. We've been there and done it before. That's a very different sort of set of obviously skills, but also in terms of that narrative that we're hearing a lot out there. People talking about the theory of operating a mine versus the reality of having done it and actually knowing how to get it to that point where you can get it financed, you can get it into production. So in terms of your USP, this guy last time out made a very good case for how we're going to go about making money, which is great. Where are we today, though? What's the reality of what you've seen, John, since you've been on board in terms of this company's ability to kind of move through the phases?
So to get to the end of the race, which ultimately is a construction decision, build it and then operate it.
Yeah.
There's two paths you've got to go down. There's the whole technical engineering, permitting, social piece, operational readiness, find the people, build that capacity. And at the same time, which is where we're so lucky to have Cal, the whole how do I fund this? How do I actually arrange debt, equity, the myriad of ways there are to get the cash to let you to make a construction decision. And we've got both sets of skills in-house, and I think that's really powerful from a Liberty shareholder's point of view. They can have the confidence that we know what we're doing. Cal's got a tremendous track record in funding mining ventures. I've had the privilege of building 2 mines in my career. We've got a tremendously talented team on the ground that's doing the initial stages of that social engagement, social interaction to build social license. And we've sort of started early in the permitting process. And generally, I would say probably 90% of the time, the critical path from a pre-feasibility study to a construction decision is permitting. It's not engineering. And in the US, as you know, when you're on federal land, you permit under NEPA. That stands for the National Environmental Policy Act. And that lays out a really quite prescriptive process that you have to go through. And we have started early engaging with the Forest Service because the entire deposit is on forest land.
Yeah.
So Forest is the lead agency for that, and we are engaging with them. And they have, in fact, recently appointed a full-time permitting manager to be responsible entirely for black pine permitting.
Right.
And that role will coordinate between the forest requirements, the BLM requirements, because you may recall the deposit's on the forest, but the heap leach and the processing facility is going to be on the BLM land. That's the Bureau of Land Management. Yeah. And then, of course, over the top of both of those, we have the state. And the state regulates water, air, and a bunch of other things. Yeah,
I was going through the document earlier this morning, and it's a big, long list of things that need to be delivered. And what's the sort of time frame for? I would love to get into details, certainly around the forestry bit in a second. But what's the sort of time frame that you're aiming for?
So to start the process, you need a mine plan of operations. That is essentially a pre-feasibility study, but reformatted in a way that the government wants. So finish pre-feas, reformat that to mine plan of operations. Our plan is to have pre-feas finished and published Q3.
Okay.
Q4, we'll submit the mine plan of operations to the forest, and then that starts the formal NEPA process. Yeah. There's quite a lot of detail I can go into if you want to hear that, but basically the timing is 3 years.
3 years, okay. So that's the quick answer. What I do want to get into the detail, because I'm looking at some of these satellite images. I'm looking at some of the maps and charts that you provide. It feels like forestry would, you kind of imagine, sitting from outside, why would they be kind of pro-mining or even countenance a mine, open pit mine at that, on their land? And have you secured all the land yet that you need for the
absolutely. Absolutely, we have all the land.
Right, so that discussion, what does that look like? Because I was saying to Susie earlier this morning, it's one of those things. I was with a couple of ministers last night, and in a shorthand, their key driver was, don't make me look bad. I'm not
Right.
going to let
Right.
you or
Right.
put you in a position where you could possibly make me look bad, right? That's the kind of key driver. For that to happen, you need to have, ticked off quite a few boxes in here. So
Definitely.
example of that. So the forestry discussion looks like what?
So, first comment, even though this is the agency responsible for the land is the US Forest, this is not a forest. The mine is, or the deposit's located in an extremely arid area. It's juniper pinyon, which is kind of scrubby trees and low brush.
There's a picture in your PowerPoint.
This is
Yeah, we
not,
get a sense
so it's
of
not
it,
a,
yeah.
it is a forest, but it's not a forest in the sense that one colloquially might think of a forest.
Yeah.
So that's a first. And plus it's a previously disturbed site. There was a mine on the site before. There is an old heap that's been rehabilitated. So this is, it's what they call an impaired view shed. So the
So is that again?
impaired view shed.
Well done.
That's a technical
It's
term.
8:30 in the
What do
morning.
you think? What do you think? Technical term. And believe it or not, well, actually, perhaps you would believe it. That's really important in the US. If you are wanting to do something in a mining sense that breaks new ground and changes the view that the public's used to, that's a problem. We don't have that problem. That's another one of the issues that
you
we
don't want to be
face.
next to Yellowstone Park.
Right.
You want to be
Or-
next
or
to a bunch
Salmon
of grasslands
River, right.
with no community and no
Yeah.
people and no running water.
Good news. It sounds quite cheap. You're not spending vast sums of money at this current moment in time, or are you?
Well, we're saving money due to the impaired view shed that we don't have. I don't know how to answer that question.
He started, folks.
You just started a wave of impaired view sheds.
So there is a cost to the process. It's not
there-
cheap.
I know,
it's not
but
cheap at all. I mean, you
Yeah.
have to go through. You are required to do a series of baseline studies.
Right.
And there's a list, and we're negotiating. Well, we're discussing that list right now with the agencies.
But see, this is the interesting thing because Carl talks at the beginning about remaining in control, and part of that control is going to be financial, right? So
Absolutely.
you haven't got like hundreds of people and 10 drill rigs turning here. You're at that kind of point at time where you've kind of done the heavy lifting, and this is about finessing and repackaging or packaging it up to get those permits in place. So it's a three-year time frame. Great. What are the other kind of big long poles in the tent that we need to be worried about, or you need to be worried about?
Well, personally, I'm not concerned about money because I can get that from multiple different sources. So that part, it's just when and how and the numbers. Okay. So when we were at BMO and also here, we met with the debt people because we wanted to compare
you talked about that.
4 or 5 different debt lenders and see what their bells and whistles were and where they're trying to catch us up. And then we put that all together. Then we picked the preferred 2 or 3 people to talk to, and then you get rid of the others. Right? And debt is a really problematic issue in the fact that there's so many bells and whistles you can add to it that all of a sudden you've assumed a debt to build a mine in 3 years' time. That's over 20% rate with all the things that they are asking for, right? And they're not the most generous of givers when it comes to debt to build a mine. And then you've got to figure out a ratio of what percentage is debt, what percentage is equity, right? And as you advance these things, you're still going to get the approaches from public companies who look at the modeling of what your mine life is and how many ounces per year and what's the potential to go from now at Black Pine 3.5 million ounces to 5.5 million ounces. And so we gauge all of this together, and then we have our meetings with different people, and we never stop meeting.
But tell me this: we've seen a few mergers last year, mergers of equals, and it was just I don't think they worked out quite well, quite frankly. I think it was a merger of desperation in a lot of cases.
Yeah,
right?
I'll agree with that.
But what some people have done, and I think it's certainly helped a little bit with the narrative in terms of keeping them relevant, which is just that sort of change of strategy, right? It's saying like, let's not aim for 5 million ounces. Let's work out how we get things moving at, say, 3 million ounces or 2.5 million ounces.
Well, you do that.
Revenue flow, right? But it wasn't always the way. I'm saying, but it is now.
No, nowadays I think you have to go take a mine life and just think with the one number, 15.
15, why?
15 years.
15 years,
Okay, so if you've got 1 million ounces, you take your recoveries, divide it out, and you're a 30,000 ounce producer for 15 years. Right? So that kind of thing, right? Because you're not going to get all your metal out of the ground. And then once you get to, say, 3.5 million ounces, then we're modeling it 15 years at 150,000 ounces. You find another 1 million ounces, we're now modeling it at 15 years at 175 or 185.
Okay.
That's how you have to do it. So you have to keep exploring until you get to a magic number, and I think our magic number, John might disagree with me on this one, is around 5 million ounces. And then you're up in the 200,000 ounce range, and you're in a tier 1 asset, but you still know you're going to extend mine life.
Do you agree?
I do.
Answer.
Five is the right number. Five is the right number.
Correct.
5 is absolutely
Correct.
the right number. But the interesting point, just to build on what Cal's saying, every time, and particular with a deposit like Black Pine, when you look at it, when you look at a model or a set of economics, that's a snapshot in the time of that deposit.
Yeah.
That's right.
These things get drilled and drilled and drilled, and they grow and they grow, and so an economic view or a way to mine something for a resource of 2 million ounces is not the same answer if it's 4 million ounces, which is not the same if it's 8 million ounces. You approach it differently.
Yeah, and I guess when I'm kind of asking about this, we had a CEO on, say 2 weeks ago, came back, 15% IRR. The market went, what the heck? And he was like, deal with it. Either we're going to continue to dilate the heck out of you, or we can start here, but not just as Cal said, we will continue to build this thing out. We'll extend the mine life, we'll increase the output, etc., and that will change the economics. But at this moment in time, 15 stops you guys being diluted. And I think that's what I mean about what I said earlier about some companies being brave enough to say, look, it's tough out there. We've not got too many levers to pull. So let us trust us to actually get on with it. But what he must do is actually build a mine which works, even at 15% IRR.
Right.
And that, do you know what I mean? And very few mine builders out there. Very few people actually build economic companies.
But sorry, John, but if you have a 7-year mine life, you might go through 1 gold cycle.
Yeah.
You got a 15-year mine life, you might go through 3.
Yeah.
And that's all goes to margin down the line. Because the gold price, as we started with, it steps.
Yeah.
Right? It tends to do that.
But it's like, if you take Rox Gold, for instance, the Aussies, you know, I think they were in, I can't remember which country in West Africa, I'm going to go Côte d'Ivoire maybe. 5-year mine life, but it's high grade, high margin.
But they kept replacing those ounces.
It was always 5 years. Right.
And I was one of the seed founders of that company.
Okay.
Yeah.
So John.
But the thought I was going to have, you know, that idea of I got to start something that's economic, that gets me up and running.
Yeah.
That's exactly the situation we're going through right now with the pre-feasibility study. There are always multiple solutions to how do you mine something. There's the big bang, largest I can do, generally highest capital investment, initial capital, biggest fleet, large movement, largest metal production. That's generally your highest NPV case, highest value case, but also requires highest capital. There's another case, which is what's the minimum capital case I can design that gets me in to start it, phase 1, shall we say.
Yeah.
Typically that means higher grades, so your payback is shorter, but it's not the highest value case. You're going in at a lower value case, but a case that a company like us could fund potentially if it's the right capital number, and then you expand 2-3 years down the road.
So it's, I think we're in violent agreement with each other. It's like, it's not necessarily the most efficient, but it might be the most appropriate in the context of what's happening in the marketplace. So, right. So if I'm an investor, your message to me is what? Get contrarian. Start looking at value versus share price right now, because it's coming. Why are you guys any more likely to
Let me have the
succeed?
first word, and I'll give the last word to the boss. My thinking is, I've always enjoyed the developer space where you're kind of unloved, and there is a strong school of investment thought that says pick that developer just as they're getting some permit certainty. Pick a developer that's got credibility to be able to do the engineering, and then raise the funds and build it, and you'll ride that curve all the way up. We're right in that space right now.
Yeah, and my advice to anybody who's in this space, if you think it's going to be a mine, finite, don't invest in everything, just pick what you think is economic. And when you find one, buy a lot of it, okay? If you're going out to go to 20 companies and buy 10,000 shares of all 20 companies, inevitably you're going to be lucky to break even, right? And you have to be able to go through the database, which we're both trained to do, and analyze, okay, that's going to be a mine, okay? I own roughly 10 million shares of Liberty because we believe it's going to be a good mine, okay? And if I find another one, I'll go buy another company. And it's so rare for me to find another company that I think is going to be a mine. And I spend every day of the week reading 43101 reports every single night of things that come out. It's tough to find one every 6 months.
No, I hear you. I definitely agree with that.
It's really, really tough. And so if you can understand the economics of what makes an economic deposit and understand the politics, the jurisdiction, the capital that's required, and especially the quality of the management of those companies, then you're fine. Because if you go out and find something that looks like it to be a mine, but the management don't know how to raise a nickel, you got a problem on your hands.
Well, the thing is, it even wasn't that. It's like some of the investments you're planning or making haven't made a discovery yet.
No.
And it's hard. Right. People just think, oh, they're drilling, so they'll make a discovery. It's so hard. So I think we are certainly leaning towards and certainly, pointing our viewers, subscribers, etc., towards development stories at the moment in this kind of market like that, because it's much more de-risked. But even when we get there, and this point of today's conversation is, I'm not sure every one of those guys will be able to raise the money and get into economic production.
I agree.
Because it's hard.
Yes, it is. It's tough. It's tough to see it through, and it's tough to have the right people.
And there's a level of interference here, because if you know you've got a mine, I don't care which commodity it is, you know it's economic and you got a mine, the public companies, the producers know you've got a mine. And they're more prone to interrupt what they think is going to be a mine than an exploration property. It's as simple as that. And one of the most overly used words in this business is, oh, we're going to get taken over. How many times have you heard that?
Yeah, because you're out of control.
Out of control, right? And they're grasping at straws looking to raise money or whatever their objective is, but so few ever get taken over.
Yeah, I know. It's a very desperate strategy, I think, generally. Look, guys, and we're not having a conversation of can you make discoveries, tech. We're not having a conversation about have you got the answers. You do. This is a case of, with the money which this guy gets for you, are you able to do what you need to do to ensure that this thing gets over the line and gets into production economically? So, and when you're looking at the asset itself in terms of the grade, the depth that you're going to have what this pit looks like, what are the things which perhaps are not concerning, the things that kind of drive you to maybe spend a little bit more time and attention on that need that right now?
So from a sort of technical perspective in terms of our design, I think this deposit is going to not live and die, but the economics of the operation are going to be very strongly driven by haulage. So
right.
It's open pit mine.
Oh, we talked about rubber tires, didn't we?
We did talk about rubber tires.
Rubber tires, yeah.
And
I still talk about that.
Oh yeah, well that's a big call.
Last night, I'm pretty sure I brought that up.
Well, there we go. And it remains true today from the first time I told you. Yeah. But the design of the pits, and that sounds a bit daft, but how you design it, the waste ore ratio in each of those phases, how far you have to haul from that area through a road network to the place where we treat it, the heap leach. The cost of that is critical for the underlying operating cost of this deposit. So that design and how you move material in space and time is really where the focus has to be.
And just one last question with regards to control. Is there any expectation from you guys as to what the state needs to do for you in terms of spending money? Not the permitting process and approvals and so. I'm talking about, are you expecting them to spend any money to help your economics, or are you saying, don't worry about it, if we get the permissions, we're good to build this out ourselves?
We have no expectation of the state.
No,
The state's not required to
Okay.
do anything, nor is there any necessity for the state to do anything. There's a highway literally 3 kilometers from the main access road. There's an access road to site. Water we're responsible for, power we're responsible for, so no, not really.
Okay.
The Idaho state has a sort of indirect leverage. They have they're building a very strong kind of apprentice training program, and it's the governor's program, and he's providing grants to young kids who want to be mechanics or electricians, and there's a financial grant there, because he's recognized he needs to upskill young people. So we will benefit indirectly from that, because we're going to need apprentices. Okay. We're going to need motor mechanics, diesel mechanics, and all that kind of stuff. So almost certainly we will have discussions on that training level, and I know some of our peers in Idaho who are in the development state have had those discussions. We will likely talk to the universities. We'll probably create bursaries and supports for students through longer term. We've got to grow a capacity and a capability. So the state will be involved in that.
Yeah, and different states think differently. For our Goldstrike project in Utah, there's a policy there where you can, if you put in power lines and water lines and road infrastructure, you can deduct that over a period of time as a tax deduction from your cash flow. That's given by the state. You don't get that in Idaho. You might not get that in Nevada. But they're all somewhat different, but they all help in their own way. It's like you started off saying that you met a couple of government ministers and said, just don't make me look bad.
Yeah.
The companies think the same way to the governments they deal with. The government don't make us look bad, right? So you have to have that business relationship on both sides and open discussions and truthful disclosure of what's going on. And if you've got an issue, even with a power contract, or you don't like the numbers you're seeing, you can go to the state and ask them to dig into it for you. Then they'll gladly do that.
Okay. Better wrap it up, because I know you've got places, it's busy out there. What are we looking for this year? I mean, what are you pointing us out and say, these are important moments this year, pay attention?
Oh, that's pretty easy. We're looking for PFS in about 5 months to come out. We skipped a PEA. And one gentleman said to me yesterday, there must be something wrong with your project. You skipped a PEA? The most optimistic numbers you could ever put on a project? And I explained it to him. It took me about 15 minutes, then he understood we had that much confidence in the project to skip a study that was going to take time and go right to a PFS.
Yeah.
Right? So that comes out in about 5 months. We expect with it before that to get a new plan of operations that gives us another 10 plus square kilometers to drill. And there's 7 major drill targets in there to build ounces on, to add to a 3.5 million ounce resource. And then after that, and put out more metallurgy. And then at the same time as advancing through the full NEPA process by the end of the year, that's going to be ongoing, but then we want to turn the drills on again in, say, July.
Okay, that's the order of play.
And we've already secured 3 drills to go.
Okay, guys.
Pleasure as always.
Good update. Good to see you soon.
Pleasure.
Okay, we'll see you soon.
Oh, yes.